It occurs to me that I must have been interested in oil for a long time, probably because I lived in the Middle East and wherever the presidency of OPEC was, that's where I happened to be living at the time, and I did that for a number of years. But I recall that the first presentation I ever did on oil in Morgan's was for a gentleman called Robert Ashton, who was the ran a branch in Darwin. And what I developed for that, to show at that presentation, was a model of the oil price at the beginning of, like 20 years ago, the beginning of the century, in which there was a major oil slump, and people kept asking me why there was this major slump in the oil price. The oil price had been as low as $12 a barrel in the previous period. And so I looked at the various normal explanations people talk about, the US explanations, stocks of oil, that kind of thing. And I found that really what was determining the oil price was not oil production, but consumption of refined petroleum product. And I found that the best source of data for that was not US data, but whole of world data produced by the G20, the International Energy Association. And that model worked pretty well for quite a long time until recent years. And what that model was actually driven by was that most of the demand for refined product was in the developed world, was in the G20. But more recently, that's no longer true. The big demand is outside the G20. The big demand is in emerging economies. Growth is in emerging economies like China and India and other countries as well. So it's really not measured in that system anymore. But what you got left is you got data on oil supply, and so I've been using that up until this year as my primary model. This year I've switched to a model based entirely on US data. The US data is simpler and easier to get. It's more rapidly updated. Instead of being published, being available after a 2-quarter lag, it's available after a 2-week lag. And that's the model you'll see in the quarterly presentation. The model for West Texas Intermediate Grade explains about 85% of monthly variation, which is the best model we've had in a while. The model for Brent explains about 82% of monthly variation. In the model, what you've got is barrels of oil, as reported by the Energy Information Authority in their weekly report, which actually turns into a fortnightly report when you keep accessing it. And so that's the stock levels. And right now, what's been happening with stock levels of oil in the US is they went up a long way and now they're going down. They went up from 403 million barrels in 2018, up only a little bit to 422 by September 19, 429 by December 19, but then they kicked enormously by about 27% to 533 million barrels in the middle of this year, and since then they've fallen, and they've fallen to 488 million barrels. Still higher than 2018 and 2019, but way lower than it's been in the middle of the year. And of course, in the model, that's what puts upward pressure on the oil price. The other major factor in the model is the US dollar index. And it's kind of interesting, since we've got a model here of both Brent and West Texas, is that the influence of the US dollar index on the international price is probably, unsurprisingly, much, much stronger than the influence on the US domestic price. So the influence of the US dollar index on Brent is much stronger than the influence on West Texas. And the oil price movement, so the currency effect moves into the West Texas price by competing with Brent, but Brent picks up US domestic supply by competing with West Texas. So it's an interacting market. Where does it take us right now? Well, we're past the peak of the level of US oil inventories. Like I said, they were 533 million barrels in the middle of the year. and now they're 488 million barrels. So that suggests the oil price should go up. And we're significantly below, we're about 8% below the peak in the US dollar index for the year. It was running at about 100 in the middle of the year, and now it's running about 92 and change. So both of these influences suggest upward pressure on the oil price. The model seems to lead the oil price by 3 to 4 months. And what the model says yesterday is that as opposed to a price of West Texas Intermediate grade of 43.40, fair value is $52. So West Texas is $8.62 cheap. And with Brent, which the price yesterday was $45, the fair value is $56.70. So the price is almost $11 too cheap. So these models, which you'll see, show that both of these models of the West Texas Intermediate grade and Brent suggest the oil price is going to go up about $10 in the next 3 months, and there's no reason why that process won't continue after that.